Hey everybody, it's Jim Hiles from First Capital and Build Plan 101. We're calling today from our New Jersey offices. I was in Florida over the weekend taking care of some family issues, so I apologize if I missed anything over the weekend, but there was a lot going on, so I don't think we missed a whole heck of a lot, other than the weather in Florida is definitely nicer than it is in New Jersey. The housing prices are insane. You can't find a rental anywhere. Everyone seems to be moving there and spending tons of money on Florida real estate. So it's a crazy time down there. It's a crazy time all over the world when you look at what's going on. Today is the 28th, last day of February. We're looking market Monday, and certainly you have to start at what's going on with the Russian invasion of the Ukraine. All of you probably are aware and seen much more news than I'm about to tell you, but from a market standpoint, the Dow Jones was flat. If you can just say, what? We just invaded, the market was correcting, we're crashing, all this, that, and the other thing. Actually, the NASDAQ was up 1%. The S&P was up almost 1% last week. The international stock markets were down 2.5%. The volatility was elevated, but not crazy elevated, 27. So what does this all mean? What basically everyone's watching Putin and seeing what he's going to do. And this is certainly an issue, and there are a lot of opinions, but the fog of war is a thing that keeps coming back in my mind. Is no one really knows what's going on. The media is having just a great time with this as usual. And we're not exactly sure, but we do know this, that Putin has put a lot into this. He's actually gambling we think his political future on this. And he's gonna probably remain committed to taking some ground and then potentially negotiating. I don't know, maybe he takes the whole thing. I don't know. I don't think anyone knows, but they're having supply chain issues in the Russian military, just like we are having supply chain issues here. So all kinds of opinions and threats about this. What we do know is that when we look at history, and you can't ignore history, although sometimes I cringe, but we do know that history may not repeat itself, but it often rhymes, I think was a statement somebody said. When you look at this, geopolitical sell-offs are generally short-lived. Over a period of looking at the past 8 major ones here, this is from Vanguard, there's a 5% average total return, positive 5% 6 months after the event, and 8.9% positive average annual rate of return 1 year from the event. Look at the events, Cuban Missile Crisis. Many people are saying that this is the Cuban Missile Crisis of our age. And yes, the market was down 5%, a year later up 26. How about the Soviet invasion of Afghanistan? That sounds somewhat familiar. Down 5%, up 26. You kind of go through this whole concept. Even 2014, we were at the Ukraine again, and that conflict, it was down a little bit, up 12%. So there are a number of situations where geopolitics, often shock the system, and the system recovers fairly quickly. Now, we don't know what the future is going to bring, but there are also some other, what I think, positive aspects to this. Some of the positive aspects of this have to do with what's going on here at home. This is likely to change the presidency, or at least the direction of or control over fiscal policies within the Fed and potentially within the Biden administration. In other words, it's highly unlikely we're going to see a lot more money spent when this is going on in the international space. We are likely to see oil being around for a while. We're not going to be green in 5 years, more than likely. There are a lot of other issues which go into this in terms of supply chain. This is obviously affecting our supply chain issues and how inflation is going to be dealt with. Inflation is likely to stick around a little longer now. Maybe it's the end of the year, maybe it's 2 years, we don't know, but plan on this inflationary push continuing. And we're going to have to work with that within a volatile market. And I think when you look at this overall, you got to kind of look at downturns are expected. This is a correction. Now we are not in a recession. We are in a secular long-term up market, what they call a secular trend in the equity market. It's different in the fixed income market. The fixed income market has definitely seen themselves enter into a difficult period because they're looking at rising interest rates. We may see a kind of a pullback in terms of where the Fed is going to actually increase. Maybe they're not going to go as high as what the market thinks because they can't screw things up by pushing rates up too high, too fast. Now, they're probably behind overall. They should have started this probably I don't even know how long ago, but they should have done this earlier. But when you look at what's going on just from this chart basically says that there are bull markets, there are bear markets. And there have been 13 corrections in the last, this is 1980, 13 corrections, which a correction, by the way, great term we've made up in marketing here for the markets. A correction is 10% decline or more. Bear market, that is 20% or more. Okay, so those are just rules of thumb. And they generally last more than at least 2 months as a bear market. We think we're probably in a correction, not a bear market. We do not think we're going into recession. And trying to time this thing is very, very difficult because the best and worst trading days are often right behind each other. You'll have a huge sell-off like we saw, these huge sell-offs in the last week. And then 1 or 2 or 3 days later, boom, the market takes off in the other direction. I mean, if you're trying to time that, there's no way you're going to know. So generally for most investors, I would stay away from that kind of stuff. We are trying to move strategically and trying to protect where it makes sense to protect and trying to take advantage where it tends to take advantage of certain opportunities. When you look at what volatility means, again, you have to understand this happens. We've been talking about what volatility is. People say, well, volatility, well, what's that? It's up and down in the market. That's just the way it's the price of the 8 to 10% return that we expect to get over time. So accept it. It is what it is. This is more the rule than the exception. And it is going to give you positive rates return over the long pull, something which also will probably have a better return, particularly for stocks in an inflationary environment. In the first several turns of the interest rate actually bodes very well for stocks. So we're not looking at this shutting down the stock market at this point when you look at what's going on with interest rates and inflation. But you got to manage your expectations. When we talk about averages, the stock market average is about 10%, bonds about 5%. Well, how often does it actually fall into this average range? This is little blue line right in here says very actually rarely does it fall into average. So you can't think of this like every year I'm going to get 10% on average, plus my next couple percent. It doesn't work that way. It actually works quite a bit differently. You can be down 30% and you can be up 30%. It's that far a swing or dispersion from the mean. So that's enough jargon for today in terms of that. But again, just hang in there. Stocks aren't going to be crashing anytime soon as far as we can tell. So just keep in mind that we are watching this like everyone else is. I'm not going to say uncharted because I just hate that word, but we're dealing with the information that is being presented to us and we're acting upon that in a prudent fashion. That's the best thing you can do in an environment like this. So hopefully this helps. If you have any questions, please feel free to reach out and talk to me. Thanks. See you.